Welcome to the Deep Dive, where we tear into the most important financial and strategic updates so you can quickly understand what really matters.
And today, we are really cracking open a tough one.
We are. It's the Q1 fiscal year 2026 earnings for Nutanix, ticker NTNX.
This call happened after hours on November 25th, and the reaction the next day was, let's just say, brutal.
Brutal is the right word. A shocking repricing. We're talking about a stock that closed down nearly 18%.
And the volume was just incredible, almost 7 times its average. So, what we're trying to do here is figure out this massive split.
A split between what management is saying and what investors are doing?
Exactly. Management says demand is solid, the problems are just timing. But investors triggered a massive sell-off that screams deep structural fear.
Okay, let's start with the top line numbers because they tell a really confusing story at first glance.
They really do. On the surface, profitability looks great.
Non-GAAP earnings per share came in at 41 cents. That's perfectly in line with what everyone expected.
Right on the money. And their GAAP EPS was 21 cents, which is a phenomenal 110% growth year over year.
So with numbers like that, why the mass panic? Where's the fire?
The fire was on the revenue line.
Yeah.
And even more importantly, the forward guidance.
Okay.
Revenue came in at $670.6 million. Now, that's inside their own guided range.
But it missed the street's consensus.
It did. The consensus was around $676 million. And in this market, even a slight miss can get punished if the outlook is murky at all.
And their outlook was definitely murky. But what about the underlying health metrics? They've always told investors to watch annual recurring revenue.
And that's the thing. ARR didn't show any drop-off. It grew a really healthy 18% year over year to $2.28 billion.
That's a strong growth rate for a company this size.
It is, and this is the central paradox we have to wrestle with today. You have proof of long-term contracts being signed, that ARR is robust, but the market is just hammering the stock.
Because management signaled serious problems with the timing of recognizing that revenue.
Exactly. The market isn't questioning if people want Nutanix. They're questioning the reliability of when that money actually shows up on the books.
So let's dig into the health of the actual business, because the long-term numbers are genuinely powerful.
They are. Beyond ARR, subscription revenue itself was $637.8 million, up almost 14% year over year.
But the number that really shows future commitment, the one that kept pointing to on the call, is the remaining performance obligations, or RPO.
Right, the RPO. This is their backlog. It's money they are contractually obligated to receive. It's booked business.
And the RPO grew like a rocket.
It really did. It hit $2.67 billion. That's up about 26% year over year.
A 26% increase in contracted, committed business. You can't really ask for a clearer signal of strong demand than that.
You can't. And you pair that with non-GAAP gross margins hitting 88%, and you've got a business that is both in high demand and highly efficient.
And then there's the cash, the actual cash it generates.
This is what really sets them apart.
Yeah.
Operating cash flow for the quarter was nearly $197 million.
Which turned into free cash flow, or FCF, of about $175 million.
Right, giving them a quarterly FCF margin of 26%. I mean, that is just a fire hose of cash flowing into the business.
Absolutely. When a company is this cash rich, you're not worried about survival. You're wondering how they'll spend it.
So it brings us back to the main question. With all these great metrics, committed contracts, huge cash flow, why did they miss revenue and why did the stock get destroyed?
To answer that, we have to look directly at what management said. The CEO was emphatic about solid demand.
He even said that bookings, so the actual signed contracts, were slightly ahead of what they expected for the quarter.
Okay, that makes it even stranger. If you sign more contracts than you planned, how on earth does that translate to less recognized revenue?
This is where the CFO's explanation is just. It's critical. She said the shortfall was solely a timing issue.
Just timing.
Just timing. She claimed late quarter deals and some new license dynamics pushed revenue recognition from Q1 into later quarters.
Okay, but if the CFO says it's just timing, why is the market treating it like a complete system failure? What's the specific reason that these signed contracts aren't turning into revenue right away?
Well, they cited 2 main drivers, and both are tied to their deals getting bigger and more complex.
All right, let's unpack the first one. They mentioned increased customer flexibility.
Right. So think about it. Historically, you sign a software contract, the revenue meter starts ticking immediately.
Sure.
But now, with these huge, complex data center migrations, customers are asking for a delay. They want the license to officially start when they actually begin the deployment, not when they sign the paper.
Which could be months later.
Exactly. These migrations can take months, sometimes longer. So Nutanix agrees to this flexibility, which helps them win the massive deals, but it's terrible for their short-term revenue recognition. The start date just gets pushed out.
Okay, so that makes sense if you're overhauling your entire infrastructure. What's the second driver?
This one is, I think, more structural, and it's what's really spooking investors. It's the growth of their third-party OEM channel.
Meaning their big partners like Cisco and Dell?
Correct. When they sell through an OEM partner, Nutanix can't recognize its software revenue until that partner, say Dell, physically ships the bundled server appliance to the final customer.
Ah, okay. I see the new risk factor there.
It's a big one.
So Nutanix can have a confirmed order, but if Dell has a supply chain delay or a manufacturing issue, the revenue for Nutanix gets pushed out.
Yeah.
It's totally out of their control.
You've got it. Management sees this as a huge strategic win selling through these massive channels, but it introduces this structural volatility into their revenue forecasting.
So management is saying, we'll get the money, it'll just be later. And investors are saying,
We hate that we can't see it coming. We hate the lack of control.
and that complexity is really tied into their biggest strategic win right now, which is this whole VMware diaspora.
That displacement wave is the biggest tailwind they have. I mean, it is a huge driver.
They added, what, something like 640 new VMware customers this quarter?
630. And that's on top of the 2,700 plus migrations they won in the entire last fiscal year. So the pace is accelerating.
That is a massive number of large companies choosing to rip out a major incumbent in a single quarter.
And it perfectly validates the CEO's point about deal complexity. These aren't small deals. These are multi-year strategic overhauls that absolutely require those flexible start dates we were talking about.
Right. The size of the prize directly leads to the timing problem.
Exactly. But they aren't slowing down their expansion. They're actually doubling down on partnerships and products.
What stands out there?
The big one was upcoming support for Microsoft Azure Virtual Desktop, or AVD, running on their own Nutanix AHV platform.
That's a big deal for their VDI positioning, right? Virtual desktops are a huge part of hybrid cloud.
A huge part. And they're also deepening the very OEM relationships that are causing these timing issues. They announced expanded support for Dell PowerStore coming in summer 2026.
So they're betting the long-term strategic gain is worth the short-term forecasting headache.
It seems so. And you can't ignore the outside validation either. They were just named a leader in the 2025 Gartner Magic Quadrant for Distributed Hybrid Infrastructure.
So strategically, it really does seem like everything is firing on all cylinders.
Which is what makes the guidance cut so jarring.
Let's get to it. This is the real source of the investor shock, the guidance reset.
Yeah, this is where the solid demand narrative just slammed into a brick wall of forecasting reality. The cuts were severe.
How bad was the Q2 guidance?
They guided Q2 revenue to a range of $705 to $715 million. The street was expecting something around $749 million. That's a massive miss.
Just a huge gap. And the full year picture wasn't much better for anyone focused on top line growth.
No. Full year revenue was guided down to between $2.82 and $2.86 billion. The consensus before the call was up around $2.92 billion.
A cut that big usually means one of two things. Either demand is falling off a cliff or competition is eating your lunch.
Right. Which is why the positive trade-off they offered is so important, and also why it was completely ignored by the market in the heat of the moment.
Despite cutting revenue guidance that much, they maintained their non-GAAP operating margin guidance.
They did, at a very healthy 21 to 22%. But the real kicker, the thing that is just so wild, was the cash flow.
They didn't just maintain it.
They raised it. They significantly raised their full-year free cash flow guidance to a range of $800 to $840 million.
And that's the countersignal the market just completely tuned out.
It's the ultimate trade-off, isn't it? Management is explicitly saying, look, we might not recognize the revenue when you want us to because of these complex deals, but we are absolutely confident we're going to collect the cash.
They're choosing cash generation and margin quality over clean, predictable top-line growth.
And that decision is the absolute core of this timing versus structural debate.
And management says it's temporary noise.
And investors are worried that this is the new normal, that these complex deals have introduced a permanent volatility that makes their forecasts basically untrustworthy.
I saw that the options market was only pricing in about a 10% move after earnings.
Right, and we got a nearly 18% drop. That gap just shows how completely shocked institutional money was.
Yeah.
They are pricing in the risk that management is fundamentally wrong about this being a temporary problem.
The market wants proof. They need to see that deferred revenue actually show up in Q2 and Q3 before they'll believe it.
Until then, the stock is just priced for pain.
All right. This is a very complex picture. You have a strong business model wrestling with some really tricky revenue mechanics.
It really is.
So before we wrap up, it is time for our segment. This is not financial advice. We break down an outrageous but plausible trade idea based on what we're seeing.
And the premise for this trade is pretty simple. The market is acting emotionally right now. It's valuing Nutanix as if demand has just evaporated.
When all the underlying metrics, the 26% RPO growth, the 18% ARR growth, and that massive $800 million plus FCF forecast all suggest the exact opposite.
They're punishing a cash machine for what is essentially an accounting and timing issue.
So the thesis is that the huge free cash flow guidance provides a real floor for the stock's valuation.
It has to, especially since a lot of that cash is already collected or committed up front for those deferred deals. This 18% drop puts the stock at a major discount to its own contracted backlog.
So what's the pitch?
The outrageously plausible pitch is to capitalize on this dislocation. For someone more conservative, a strategy like a buy right, where you buy the stock and sell covered calls against it, gives you downside protection and generates income while you wait.
And for someone wanting more leverage?
Long-dated, deep-in-the-money call options look very attractive. You're betting on two catalysts.
The first is that the cash flow actually comes in, validating that FCF raise.
And the second is that management shows real evidence of revenue stabilizing in the next couple of quarters. If the market's fear shifts from structural problem back to just a timing issue, that high FCF target could act like a magnet.
Potentially forcing a big reversion in the stock price.
I think a 30% plus reversion isn't out of the question just to catch up to the value that's already contracted on their books. It's a classic value play on a beaten down growth stock.
You're betting that the CFO is right about the timing and the market's collective fear is wrong.
That's the trade.
So, to bring this all home, the takeaway for you is this. Nutanix is showing incredible underlying business strength. It's validated by the VMware wins, the Gartner recognition, the massive RPO growth.
And it's a huge but. Investors are pricing in the risk that this new complex world of big deals and OEM partners creates a permanent headwind to reliable forecasting.
And that tension is captured perfectly in that guidance change.
It is. The revenue growth forecast got cut, but the free cash flow forecast got a significant raise. So the final question for you to really think about is this.
Does a big cut to the revenue forecast, accompanied by a big raise in the cash flow forecast, signal a business model hitting its limits due to complexity?
Or does it simply signal extreme confidence in collecting delayed cash and a hardcore commitment to efficiency above all else?
You really have to follow the cash flow on this one because the revenue path has clearly gotten messy.
Very messy.
That concludes this deep dive. We encourage you to continue your own research based on this summary.